Meantime, 7 of the world's biggest banks, a multi-billion-dollar loan, and one of the most infamous names in tech had all helped power the Twitter takeover in 2022. But 2 years later, those lenders are still on the hook. Deirdre Bosa has more in today's Tech Check. Deirdre?
Hey, Kelly, Twitter, now X. It is the worst deal in the Musk universe. Purchased for $44 billion in 2022. With the help of those banks, it has struggled to retain advertisers and lost 70% of its value, according to OneMark. It's the banks holding the bag. According to new data from PitchBook, the Twitter takeover now represents the worst buyout for banks since the 08-09 financial crisis. The idea behind doing this deal in the first place was put up the capital, do a deal that deepens the bank's relationship with one of the world's richest men, then turn around and sell the loans or bonds to investors who might have more risk tolerance or believe that Twitter, now X, would improve under Musk. Instead, banks have been unable to sell that debt without taking huge losses, and hung loans, as they're called, dents overall profitability for the banks. It increases their financial risk, and it reduces liquidity available for other deals. It hasn't, however, hurt Musk's own ability to raise money for other deals. $6 billion for his AI startup this year, much of that from venture capital. And here's the key difference. VC funds, they get equity or ownership in exchange for financing, so they don't have to hold on to that in the same way, very different way. They also don't report quarterly, right? They can they don't have to mark down their investments every quarter like a bank might have to.
Always something to keep in mind here. Nevertheless, Deirdre, we just got some news as well I want to address. Shein, the fast fashion site, is now suing rival Temu for, quote, an unlawful enterprise built on counterfeiting, theft of trade secrets, infringement of IP rights, and fraud as they seek to infiltrate the U.S. These two, of course, have, you could argue, even taken share from Amazon. There's been fights over whether to include them in the NRF, whether they should have IPOs here, and so on and so forth. What do you make of this latest salvo?
It's so interesting to see them sort of battling with each other, right? These are Chinese-owned e-commerce platforms that have made huge inroads with the American consumer by doing very similar things. I mean, on the surface, it looks like the business model is very similar. You're selling extremely cheap goods at a discount, sort of bargain basement prices, in order to gain more scale and build habits among American consumers. It's hard to understand what's actually going on because Shein is not a public company. It's looking for an IPO in London, but that means that we don't know what a lot of the financials look like. With Temu, which is owned by PDD Group, Pinduoduo, that's the Chinese company, we know a lot more about it. So it's interesting to see Shein sort of take on Temu in this way before they're going to presumably release their financials. I mean, it could expose them to similar claims, right? Both of these companies rely on the gamification of e-commerce, which looks like, and I'm getting up to speed on this myself, which is what Shein is taking issue with.
Interesting. Okay, I totally agree. I mean, it's an interesting strategy of trying to shine a light on someone else to say, hey, we're trying to, we're something, we're legit, we're okay.
Yeah, and there's questions about the Shein business model. So I do wonder if this is the pot calling the kettle black, but we don't know. And I think that is the bottom line for investors. Shein is not public. We don't know a ton about its business model and financials. And
I keep going back to they're popular with consumers. It kind of reminds me of TikTok, you know. They might be hated for a lot of what is going on, but they are popular with consumers, and that's going to carry them some ways.